All right, I think we should kick it off. Well, hello everyone. Appreciate you being here today. As you've probably heard, I'm Rod Crandall. We do have Andrew Casilius and George Steele on our team here today. They're waving. George is labeled George, and Andrew is labeled Nate Berglund. He is the owner of our firm. So technology, as we log in, that's how
I
that
wish.
works. Exactly. So if this is your first time joining in, thank you. This is our monthly Coaches Corner. And so what we do is every month we put together some sort of topic to present out in this format, which is always around identification and positioning. Who do we identify to talk to? What kind of positioning or conversation do we have? We really believe that to the extent you want to appropriately integrate insurance into your practice and do that intentionally, it really starts with understanding who to talk to and having a great conversation. And so if you like what you hear, understand that we do these once a month. We actually have a whole library built out of previous content as well. To the extent you like what you hear, we can certainly get you pointed in those directions. So today, over the next approximately 45 minutes, we're going to share an idea that that came to us through a guy named Jon Kling. And so I don't know, some of you may already subscribe to Broker's World. I certainly do, and I find that to be a very good source of material. And I read an article in September of 2021 in Broker World by this guy, Jon Kling, and he's a life and qualifying member of MDRT. So if you don't know what MDRT is, it's the $1 Million Roundtable, which is generally considered to be the highest association for insurance producers. So when it was founded in 1927, in order to become a member, you actually had to place $1 million worth of death benefit in place, and you became part of the $1 Million Roundtable. And so almost 100 years later, this organization is still going strong. They have huge membership and just the best insurance producers in the industry, Jon being one of them. And he was interviewed. And I said, boy, I really like what he had to say, and I'd like to share that with our folks. And so what you're going to hear today is I'm going to share a little bit about what he's relayed to us and also kind of overlay that with how we might look at things at USAdvisors and certainly how I might look at things as well. And so the first thing Jon says is that people don't do things that they don't understand. And I completely agree with that. What we talk about internally here is that it's not about what insurance is, it's about what insurance does. And so what insurance is pretty confusing and people don't understand it very well, especially when you show them a 57-page application. But if we can make it simple and we can show them what it does, right? It creates liquidity for our family. It replaces income in the event that we pass away, et cetera, right? It protects the retirement portfolio protection. If we start getting closer on what it does, not what it is, then it's simpler for people and they can and will take action. He then indicates that risk can be either accepted or reduced or avoided or insured. I like that language. What I've told people oftentimes is that relative to insurance planning, the first thing we have to determine is there a risk? If there's no risk, there's really no means for a conversation. There's no good conversation that can be had if somebody doesn't accept that they have a risk, right? Then I ask, if you have a risk, then how big is it and how do you feel about it? All right, so if you have a risk but you don't care about it, there's not much of a great conversation to be had. But if you have a risk and you care about it, then the next question is, what are our options to eliminate or reduce that risk, which is sort of what Jon's talking about here. We start having those kind of conversations. We're not even in the selling business, if you will. All we have to do is educate our clients on what is their risk and what are their options more specifically. And then they can make a very good decision, right? And then again, he says that before we discuss life insurance, we need the clients to understand these risks. And that's the thing. So a lot of times people will get into the topic of life insurance and they'll get right into quoting. Well, let's get it quoted. Let's quote 500,000, 750, and $1 million. And we've jumped the gun if we do that. And we're into that spot where maybe they don't understand what that is. They don't have the appropriate context. And certainly if you're just quoting insurance, I believe two things. Number one, whatever you're quoting is too expensive. Not because you quoted it wrong, but because if you're going to ask me to buy insurance and you told me that the insurance costs X, I think that's too much money. And I believe our clients are there too. So no matter what we quote, it's too much money out of context. The second thing that I believe is if you just quote like that, they look at the lowest number on the page, and that's the one that they might want to do. And so we're jumping the gun talking about product. We need to have a good conversation first, and we need to discuss those risks. And that's really what struck me about Jon, is how he broke down those risks around life insurance on a spectrum, which was the title for this talk, right? The spectrum of life insurance benefits. And so he says that this spectrum exists like this. And I believe this spectrum creates a better conversation, right? It's about what the insurance can do for you. What do we want it to do for us? Do you want to provide final expenses or an emergency fund? Do we need to provide family income? Is there any mortgage, debt, or college that we might need to pay off or pay attention to? And how do we deal with retirement? So I'm going to walk through each one of these a little bit more closely, because this is how we talk to clients. Clients don't need life insurance. What they need is they need a means to pay for final expenses. They don't need life insurance. They need to make sure that they can replace their income, right? And if we start talking to them about that, they really understand that better, especially the income piece. I talk to clients about them being money machines, right? In the sense that they go to work and money shows up. And if they had a money machine in the garage, would we insure that money machine? And the answer is, of course, we would insure that money machine. Well, how much would we insure it for? And the reality is we would insure it for as much as we could, because it's a money machine that's sitting in our garage. Well, we are that money machine for our families. And more often than not, the ability to earn an income is the largest asset that our clients have, right? And so we need to make sure that we protect that. But if we say, hey, you need $1 million of life insurance, it's like, what do you mean? What is that? What do you mean $1 million, right? We need to start talking about, do we need money for final expenses, emergency fund, family income, and sort of walk them through this way, in my opinion. So here's Jon's thoughts on final expenses and emergency funds. I put them together. I kind of liked his line. Somebody else paid their way into this world, so they might as well pay their own way out, right? So somebody paid for me to come in, and maybe I need to pay for my way out. It just kind of lightens the tone a little bit. I don't think I would use that language, but he certainly does, and I think it makes sense. Right. So relative to final expenses and emergency funds, what are we really dealing with? Could be potential medical expenses, maybe legal and accounting fees, could have income or estate taxes. An emergency fund, what does that look like? Usually 3 to 6 months of income. Now, again, this isn't something we tell the clients they must have. What we do is we ask the clients, how do you view these items and what would you want to have happen? And do we need to make an allocation for the total life insurance by including these items, right? So it's a conversation piece. And then obviously burial and cremation expense. Well, guess what? It's a lot cheaper to cremate somebody than to bury someone. So certainly makes a difference. And again, it's about having a good conversation, because the sneak peek is once we walk through these and we get clients to say, yes, this is what I want, and this is what I want, and this is what I want, it's very hard for them to say no to implementing the insurance, because we're asking them to fulfill what they said that they wanted based upon these items. We didn't necessarily ask them to buy insurance that they don't understand why they might need it. And I think that's the real deal, is providing the motivation for this. Okay, so if we've taken care of final expenses and an emergency fund and the like, then the next thing we talk about is family income, right? So Jon says that we can't replace the breadwinner, but we can replace the stream of income that they provide to the family. Right? And so what I ask is, how much income are we going to need then? Right? If Jon is gone, or Pete, whoever the husband is in this example, what kind of income do we need and for how long? And is it any different for the spouse? So do it on both sides, right? They understand how much income they need, and guess what? They usually need pretty much all the income they currently have, right? Now, we then have to ask them, well, are there any other places that we can provide some of this income? Because if we need this income, but the money machine's gone, do we have any other place to institute this? And oftentimes the answer is no, which is really where life insurance comes in. The client doesn't need life insurance. They need a pile of cash to pay off debt and to produce an income. But again, this conversation gets clients in the right way, go, oh, okay. We're not really talking about death. We're talking about life. Right? We're talking about how are we going to fund my family's life if my ability to earn an income goes away. Okay. So once we're done with family income, then we move into mortgage and debt, college, etc. So there are any debts that we need to extinguish. I'm going to need to sneeze here, I think. I think I held it off. So what debts do we need to extinguish, right? Do we need to pay off the mortgage? By the way, if we pay off the mortgage, do we need less income, right? So that's what's interesting is the more debts we pay off, the less income we might need. So there's more than one way to sort of look at it, but if we provided the income, are there debts that we need to extinguish? And of course, do we need to adjust that income, right? What about college? Where are we on that? Would we want to make an allocation to have the present value of the future lump sum in order to pay that? See, what all this does is you got to get agreement on death benefit. If you don't have agreement on death benefit, I think you're making a mistake by quoting. And so I'm sure everyone on the call and even me have had clients that have said, well, you just quote me multiple numbers, quote me 750, a million, million two, million five. I've done that before and I will likely do it again, but I don't like doing that. It doesn't serve the clients well. Because again, my comment before is that they're going to look at these numbers and they're just going to want the cheapest number. And by the way, term insurance on a relative basis, you're probably aware, is so cheap that I think it's a travesty to have any client have less than they need. So if we get agreement on death benefit, the likelihood that they'll implement some insurance goes up dramatically, in my opinion, than if we just try to quote them. Right? So if we talked about final expenses and the income that we need and the mortgage and debt calculation in college and whether or not we needed to pay attention to those things, then we move into retirement. So we go, well, do we need any funds available to specifically fund the retirement account? That monthly income amount that you gave me, does that include retirement contributions? And so, if it doesn't, maybe we need to account for that, right? So if we were putting $10,000 a year away while I was alive, well, maybe we need to account for another $10,000 a year in the income that we're trying to replace so that I can fund the retirement account. Again, there's no right answer to these things, and you don't dictate to the clients that that's what they need, but you're asking them, how do you feel about these things, and do you want to make a plan for that as well, right? And ideally, we would want to make that plan, because the best financial plans are run what? Whether we live a long time, whether we become disabled along the way, or whether we have a premature death. Right, so a strong financial plan we really need to make sure is protected. So we would want to protect all of these things, right? We're trying to get our clients retired. We're trying to retire. Well, candidly, I want to retire whether or not my wife lives with me in retirement, which I expect that. But if she dies prematurely, I still want to be able to retire. And certainly vice versa. If I die prematurely, I certainly want her to retire. So this is really about finalizing the plan, right? It's about, again, having a very good conversation. So a couple other questions that he has that I think are informative. How will your spouse live post-retirement if you predecease him or her? So again, getting people to think about what's that going to look like. It's easier to have this conversation if you've put together a financial plan for the clients. You'll already have a sense for their budget. You'll already know how well on track they are, whether they're in the green, in the Money Guide Pro space, et cetera. He likes to ask, what risks have you assumed in your in the vehicles that you're currently using for retirement, right? Because again, this is about risk mitigation. And so a lot of clients have rose-colored glasses, and to get them to understand that they have multiple risks, which again is easier to talk about if we have a financial plan in place, because we've probably talked about a lot of these things: longevity risk, right? Premature death or disability, inflation risk, right? Concentration risk in a single stock, perhaps, if they work for a company and have stock options, et cetera. Right? The last question: have you ever wondered why some people retire with adequate income sources while others find it necessary to work? I think we know the answer to that. It's really a planning, and that's really the value that we bring to clients, is to help them think about things and put together a plan, and then figure out how that plan is funded, right? So insurance producers will often go right to fund it with insurance, and here's the insurance. We got to hold back the insurance, talk about the plan, talk about the options to fund. And by the way, the best option to fund a plan is usually insurance, because people they don't have the assets that they need to be fully self-protected. I mean, if I had the assets I need to replace my income for the rest of my life, I wouldn't be on this call. Right? That's my goal. I'm working towards that, right? And until I'm there, which is retirement, which I call the voluntary termination of one's money machine, is retirement. You can't retire unless you can voluntarily turn in your ability to earn an income. And the only way you can do that is if you have other piles and other methods, whether that's a business or Social Security or retirement accounts or a combination, pensions, all of those things. And so what we're talking about here is if our money machine is involuntarily ruined or broken, then what are we going to do to prop it up? How are we going to turn on a money machine when yours is now gone, right? And so that's how I tend to view that. Let me pause right there and see George or Andrew if you have any comments or anything to add through this sort of process.
Andrew?
Yeah, no, I think that's great. You know, that mistake is oftentimes made where we talk about insurance a little too prematurely. I think a good way to talk about it is we have a financial plan. Let's stress test it against premature death. Where is the money going to come from to fund that retirement plan that we put together? Like you said, if we have other assets, well, maybe we don't need to work anymore, but chances are we don't have the assets. So is the insurance something that we need to think about? And that's where the life insurance conversation comes into play. What if we have a disability event? And again, it doesn't have to be somebody was cleaning the roof, fell off the ladder. Cancer, we all know somebody with cancer. Cancer can really put a damper on somebody having an ability to, again, generate income. There's a lot of expense associated with it. Doesn't make sense to look into disability insurance to make sure that we have that ongoing income to fund our plan. And then long-term care. Well, what happens if you retire? Great, congratulations. One spouse now gets diagnosed with Alzheimer's. And now you're looking at potentially $4,000 or $5,000 per month expense. That's a new expense. How are we going to fund it? Does it make sense to take a look at insurance to make sure that our plan is properly protected? So let's stress test against those three factors. And if we have other ways to protect that, great.
Yep.
But chances are insurance may be the best way to protect that.
Beautiful. I love that. You're right on, Andrew. I love that stress test. And again, I tell people you don't have to buy insurance. And I really mean that. Yeah, I'm a commissioned insurance person, but I don't believe people have to buy insurance. I believe they have to have a plan and they have to understand what their risks are and they have to understand whether they're willing to accept those risks, right? And so that's really what we're talking about. Thank you for those comments. George, anything to add on your side?
Well, just in terms of the breadth of the spectrum here, you really don't know until you have the conversation where the driving factors might be. Family income may be obvious. Mortgage might seem like a big number too, but I just had a client that frankly, the mortgage was modest. There were some other resources, but very much committed to college dreams for his 3 children. And in today's world, that's a big number. And out of that conversation probably came the most motivated part of building a number, but a number that had, like I say, a benefit and a dream connected to it. He was committed to seeing those, being sure the kids attended a premium college. And that's wonderful. It's not everyone's value, but that was his.
Correct. Well, you found the compelling reason why that person will take action. See, I believe our job, whether it's on the insurance or investment side or financial planning, is really to motivate our clients to operate in their own best interest. And relative to insurance, it's very clear that it's in their best interest to put insurance in place for their family. You know, they do study after study, and something like 50% of the population admits that they're underinsured for life insurance, but they don't do anything about it. Well, why is that? In my opinion, it's because they don't want to deal with it. They don't want to think about it. They sure don't want to talk to an insurance agent about it, right? But again, that's where us as planners, as CFPs, need to effectively help motivate our clients to operate in their own best interests. And to do so, we need to find out what's important to them. And that's what we just heard from George. And once we find out what's important to them, then we can educate them on how they can demonstrate that importance. You know, let's not forget that insurance is a demonstration of love. If you're my agent or advisor and you just ask me to buy life insurance, the answer is no. But you got to get in why I personally would buy it and why I own life insurance and long-term, well, I'm going to long-term disability. I'm very close to getting long-term care, by the way. 44, I got a lot of excuses why I don't have it yet, but I'm getting real close to that. The point I'm making is that the reason I have those coverages is really because of the promises I make to my wife. And I've promised my wife that if I'm not around or if I'm ill, that she's going to be able to maintain the lifestyle, most importantly, stay in our house, right? And she'll be able to retire. And if you are my advisor and we don't have that kind of conversation, then I'm just going to want the cheapest stuff too, because it's not fun to think about, and insurance is not a fun thing to buy. But I get to demonstrate my love to my wife without being super cheesy about it. I demonstrate my love to my wife by paying my quarterly premiums, right? Because those quarterly premiums are really being paid for her. They're not really being paid for me. And that does bring me to one suggestion that I would make, is that try not to have this conversation just with one spouse, and fairly or unfairly, especially if it's the male spouse. Because if it's just the man, oftentimes he will discount this and he'll make a decision for himself, but not his decision for his wife and his family. Right? And I've heard things like, well, she'll get remarried. Well, yeah, maybe she will. But you got 3 kids, 9, 7, and 5. The plan you want to put together is that she'll get remarried. See, what I've found is that it's not helpful to argue with clients. Sometimes challenging them is important. But with that example, I want that gentleman to say that exact thing with his wife sitting next to him. And if he says that same thing with her sitting next to him, and she accepts that, and he accepts that, then I accept it. I see George laughing. I don't know if he's ever done that, but I can tell you that.
It'd be a cool ride home, I know that.
Yeah, but I mean, literally, it's a little bit of an accountability, because again, that insurance isn't for him, it's for her. But I've asked him to buy it, right? So it's a subtlety, so something for you to think of. All right, so Jon talks about today people and tomorrow people, which I also thought was interesting. No shock, today people plan and act today. You know, we're gonna take action, right? Tomorrow people talk about it, they may or may not ever do it, right? Us as planners, we have to help tomorrow people become today people. Because why? Because tomorrow really never comes, right? I mean, that's cliche, but it's really true, right? When does tomorrow ever come? Never, never. It's always tomorrow. So what about right now? Right? So your clients want to think about it. Hey, I want to think about implementing this insurance. Well, listen, I want you to think about it too, and I would never push you. What I might suggest to you is that while you're thinking about the insurance, why don't we let the insurance company think about you? Underwriting generally takes 4 weeks, 6 weeks, 8 weeks. Sometimes it can be longer. Do you think that would be enough time for you to think about it? Well, then I might suggest that we go ahead and get the ball rolling so that we can solidify the underwriting structure, and then you can make the final decision, you know, in a few weeks or even a few months as we go through the underwriting process, right? And so again, it's all about leadership, and we have to lead through an appropriate conversation. We have to have appropriate context, and we have to educate our clients on what their options are. So here's another take, and that's my take. So I've done a lot of times where I've gone through and I've broken down how much we want in our emergency fund, how much income we need, paying off debt, college. I've done that. What I've found is that there's more than one way to do that, and it's a little bit of an art, and we often come to almost the same spot. We could just focus on income entirely, which is often what I do. I say, listen, if you're gone, what kind of income do we need to replace and for how long? And it's a lot shorter distance to the same point, because we need to replace usually all of their income. And we can ask, well, is that income enough to fund the retirement account, to fund the 529 plans, et cetera, right? And clients understand income. They understand $8,000 a month. They really do not understand $1 million death benefit. So I don't know if any of you saw a recent Morningstar report I sent to my team. It was just done last week, that the old 4% withdrawal rate is all but dead, and the new withdrawal rate is 3.3, right? So what this means is that if you have a pile of cash, you can expect to take a 3.3% withdrawal every year without running out of money or invading principal. So what does that mean relative to life insurance planning? It means that if we want to produce an income, we need a lot of capital to do so. So $1 million of capital will produce $33,000 of income according to Morningstar, right? And so the average client thinks $1 million is $1 million, and it is. If I go to the casino and I hit $1 million jackpot, it's like the best day of my life. But if $1 million is going to buy out my future ability to earn an income so that I can fulfill my promises to my wife, $1 million is not going to do it, is it? It's going to have to be significantly more than that. Right? But if I just quote, you go, you need 2 million, 3 million. Oh my gosh. No, let's convert it into income. And so you can either do the 3.3% on $1 million. Every million is giving you 33,000, but that's an indefinite income, right? The other way to do it is to solve for the present value of the income that we need. And so what I find is that we can either do that and indicate that that's going to take care of our retirement needs, or I'm producing an income out to retirement, thinking that now my income at retirement is going to be gone. So I'm taking principal and interest on my pile. And I can do that. Why? Because I'm retiring and I have other assets that can then be re-injected. So again, it's part science, it's part art. It really depends what you're most comfortable with. But in my opinion, this income, if you focus on income, you can usually have about a 5-minute conversation, maybe 10, to get to the agreement on that. And if you do it the other way, it might take 15 to 20 minutes. So I think it's about half the time. And clients, again, just readily understand income better than they understand these other large lump sum dollars, in my opinion. Right. So if we're talking on income, you can see on the screen, how much do we need and for how long? Do we have any other sources that we can count on? Does this include or not include retirement income? Is there any one-time costs? So that's where I kind of bring in that final expense. If we have that, is there any one-time cost? Should we add a final expense? Do you want an emergency fund? So maybe we have the income calculation plus a $20,000 final expense plus a $30,000 emergency fund, and I'm basically into the same spot, right? So for what that's worth, take what you like and drop what you don't. A couple other tips that Jon gives us, we've heard this from everyone and their mother, tell stories, right? Well, telling stories is great. I think asking for stories is even better. Have you ever witnessed the breadwinner of a family become disabled or need long-term care or die early? What kind of impact was that? Are you aware of that? Because there's a saying that you have to touch the heart before you touch the mind. And so we're asking people to buy life insurance. Well, that's touching the mind. You need $1 million of coverage and you need to pay me $1,000 a year. Well, where's the heart in that? Well, the heart is, what is this going to do for me? Not what it is, but what it does, right? Jon says that we insult the intelligence of people when we present only one solution. I kind of think that that's true. I don't like to present one solution, and I rarely ever do. I'm not doing it for the reason Jon says, but because I like to bring people 2 or 3 options so that they can compare and contrast, because I believe psychologically it's very hard for a client to really know what they want to do, but they can pretty quickly determine what they don't want to do. And so if I give them 3 options in pretty quick order, I can get them to say no to one of the options, which I want to do as well, because I want them to feel engaged and participating in that discussion and ultimately that decision. Also, when they say no, they're actually that much closer to saying yes, and we're refining. And so psychologically, I think it makes a lot of sense to do that, and I do it a lot. On the long-term care side, I usually call that a 3-lane highway. So we'll bring maybe a traditional long-term care solution, maybe we'll do a lump sum hybrid solution, and maybe we'll do like a life insurance long-term care, like pay-as-you-go solution. Doesn't really matter, except I'll describe, hey, there's more than one way that we can go about doing this. I've put together a 3-lane highway for you that has pros and cons, and then we can help determine what is most important to you to help them make a decision. If you just throw illustrations at them, not just quotes, but illustrations, what I find is that people get paralysis by analysis, and they don't understand these things. And in fact, it's hard sometimes for us to understand these illustrations, especially when you're looking at 12 different illustrations and trying to figure out what the differences are. And so clients can get very overwhelmed. And so again, it's part of that leadership and motivating them to take action. So if they're overwhelmed and they think the insurance is too expensive and they don't want to talk to an insurance person, they're probably not engaging at all. and then they're not being helped or properly protected. Perhaps you're not doing as complete of a job as you could for them. You might even expose your assets under management. You could potentially be exposed to a competitor coming in. Right? I'm not trying to put it on too thick or employ scare tactics, but the reality is that if you're not asking your clients for these things, who is? And I think the hard truth to that answer is that either nobody is or your competitor is. And neither of those are very favorable. And so I'll remind you also, if you're not aware, that to the extent that you don't want to go through this process with your client, I'm available for joint work. And I do a lot of joint work with people that tune into these coaching calls, and we'll do joint work and split commissions, and I can be a part of your team and I can run the whole process for you and utilize these guys behind me, as we're a wonderful team and we're kicking out insurance production all day, every day, and the average advisor isn't doing that. So your office might not be set up quite as well as ours is relative to insurance production. So keep that in mind. He says they don't want the cheapest or best, they want what's right for them. And I believe that that's true if you have the right kind of context and conversation. I think if you're just showing them numbers, they do want the cheapest. That's just my opinion. But again, we shouldn't show numbers until we really have an understanding of why they will buy. If we don't know why they will buy, we should not show numbers, in my opinion. Okay, so that concludes what this gentleman, Jon Kling, thinks about the spectrum of life insurance benefits. Now I want to talk a little bit about what can we do about this, and what are some things that I would like you guys to pay attention to as what's going on. So if you've been paying attention in Congress and the Build Better Back, it's hard for me to remember if that's what it is, Build Better Back. I think it's really close. They're looking at raising taxes in a number of ways, and the most significant would be raising marginal tax brackets, perhaps raising long-term capital gains rates, and a reduction perhaps in estate planning. And so we're already seeing people trying to get ahead of that with both accumulation strategies inside indexed universal life, which I'm going to share with you in a minute. There's some big changes there, which is this first thing here, 7702. So I'll put a pin in that for a second. But what we're seeing here is the cost of taxes for our best clients are likely going up. And so when you look at the life insurance solutions that we have, some of the best strategies we have are those that are effectively trading off the cost of taxes for the cost of insurance. And so on an accumulation basis, utilizing an IUL contract, for example, an indexed universal life, is a way that we can create supplemental tax-free income for our clients. Our best clients don't have that available to them. Part of what Congress is looking at is eliminating the backdoor Roth conversions with incomes north of 400,000. So I know many of you are engaging in backdoor Roth conversions. I happen to be a big believer in it. I actually contribute to my Roth 401k portion, even though it's painful to do that, because I firmly do believe that taxes in the future are going to be higher than they are today. We're seeing a resurge here at the agency with regard to second to die coverage because of the estate tax coming back. Even if it doesn't get in this round, it's scheduled to sunset in 2026 as it is, back to $5 million per person. And so a nice second to die policy placed in an irrevocable life insurance trust can be a wonderful asset that can produce guaranteed returns that are non-correlated to the market and income tax free to the heirs. And we're expecting a lot more of that business moving forward due to what we're seeing with taxation. Andrew, you have any comments on that before I go to the 7702 and share an example on a great accumulation structure?
No, I think you nailed it, especially on legacy planning. Clients with high concentration of qualified accounts especially are vulnerable for that, because oftentimes if they have vast amounts of IRAs, and we've worked on some cases where we literally have clients with $2 million of IRA accounts that are earmarked for the next generation. And if all the proposed tax increases take place, beneficiaries may be left with 15 cents on the dollar. So by utilizing, because let's be honest, at 72, you have to start taking out money from IRA accounts anyway. So clients will be forced to take RMDs. Why not use those RMDs, current or future, if the client is not of age yet, and reposition that into a tax-free second to die or single life product that would pass that much larger death benefit income tax-free. So CPAs are getting behind it. So if you're working with a CPA, they should be aware of it. Introducing them to some of these strategies could really be a nice source of referral for you. But again, you know, if you haven't had a conversation with clients with high concentration of qualified accounts, in my opinion, this is the time, and they would be very open to hearing some of the solutions.
Yeah, I agree, and thanks for bringing that up too. You know, it's a matter of the beneficiaries on those qualified accounts now out of the Secure Act have to spend down that money within 10 years. And so if you think about me as a beneficiary of an IRA right now, that's the worst asset for me to inherit, probably everyone on this call. If I inherit an asset like that, I have to take that distribution at my highest marginal tax bracket, and I have to do so within 10 years. And that's assuming that that money wasn't subject to estate taxes, right? And so that's very important. Now, when you think about the RMDs, well, what do we know about that? I know you have clients that take RMDs that don't want to take them, but they have to. And then they pay taxes and to reposition them back into a brokerage account. Well, I got to tell you, you should consider repositioning those into an insurance contract, like Andrew has mentioned. You can get 20-year and even 25-year returns on the death benefit in the 4 to 5% range, even insuring 70 and 72-year-old people today.
With second to die, it's closer to 8 or 9%.
Thank you. Good point. Very good point, Andrew. And so a lot of people don't think about insurance as a bona fide asset class. And so the client has $2 million of IRAs. Why do we even need to be talking about life insurance? Well, we need to be talking about it because that person with $2 million of life insurance likely has more money than they're going to need for themselves. And they're going to pass an asset that is not very efficient to pass, especially to successful heirs, right? Life insurance shows up in cash, right? And it can have a very good rate of return. And I think a lot of people aren't really aware of that. They just are focused on what it costs, right? So if you're not sure exactly what we're talking about or how this looks, please reach out to one of us and we'll show you exactly what that looks like. So I'm going to go to this 7702. Before I do, I want to just make a note that, you know, the insurance industry is a little bit challenged right now, in my opinion. You know, they have this prolonged low interest rate environment. I don't think a lot of people realize that that affects insurers pretty dramatically because they have to sit on billions of dollars in money set aside to pay future claims. And so if you look at the dividend rates or the general account rates of the carriers over the last 20 or 25 years, you could probably just sled down it, right? So you've just seen that it's just kind of come straight down. And so what that means is they don't have quite as much spread. So that creates a bit of a challenge for these companies to maintain their profitability. Now, by the way, they're maintaining their profitability by and large. But by the same token, COVID has hurt insurance companies in a couple of ways, right? I mean, they're having a hard time being fully staffed, just like a lot of America is. And a lot of their staff is displaced. And so we've seen a lot of slowdown in underwriting. We've also seen a lot of elimination of products or reduction in product performance. And I'm expecting to see more of that moving forward. One of the first things to go was these guarantees. So George and Andrew and I are always talking about guarantees because I happen to really favor fully guaranteed contracts. And what's happening is fully guaranteed contracts are going away and they're getting lesser and lesser. And there's really only a couple ways to do that. And then they want significantly more money to fully guarantee a contract than to partially guarantee a contract. Like, for example, guaranteeing a death benefit to age 90 versus age 120. And so all that to say, if it's been a while since you've looked at guarantees, now might be the time to take a look because products have changed and are changing. I do happen to believe that we're moving into a tax environment relative to insurance that's going to be one of the best tax environments to write insurance due to the relative high taxation burden. I believe it's a good time to place insurance. And in fact, maybe the best time in my roughly 20-year career, if we look at it based on what's going on with taxes and where they're likely going. But when you look at what products are available, I don't believe that 5 years from now we're going to have better products than we have today. Now, I could be wrong about this, but I believe our products are going to be more expensive 5 years from now. There's going to be less on the shelf. There's going to be less guarantees, in my opinion, because of what we're seeing with interest rates and other things. So what that nets out to, though, is that if the insurance products become a little bit less efficient, which I think that's my premise, that's what I believe, but obviously I don't know that to be sure. But if taxes go up, the cost of taxes for our best clients still far exceeds this. And when we talk to the right kind of client, they do take action. And there's a lot of opportunity there. I want to share with you one on this 7702. So we did a Coach's Corner previously in the year called the Christmas Miracle. So December of last year, the IRS updated the 7702 rules for life insurance. So broadly and generically speaking, 7702 is the IRS code that makes sure that life insurance maintains its tax favored treatment, right? And so what they did is they made a change that allows for more contribution to be put inside of a contract without becoming a modified endowment contract than we could before. And what that really means is that we can put in between 30 and 300% more premium. So the younger you are, the more you can contribute. So our average person doing an IUL might be 40 years old, and the new rules allow us to put almost a double in, right? And so what this really means is if you put more money inside of the umbrella of 7702, your insurance cost shrinks dramatically, which makes it a much better asset to take supplemental retirement income from. And so let me give you an example of what I mean. So right here, this was a real case with a 53-year-old female. Did end up getting super preferred rates. This happened to be a Symetra product. I wanted to give you the snapshot of these values. So the old product at 7702, she wanted to do $50,000 a year for 10 years, $500,000 a contribution. Okay. The old rules required her to buy $1.1 million of death benefit. So that's what she had to buy in the old rules. But the new rules allowed her to buy $754,000. So if you followed me, this is very significant because we can put $500,000 in a much smaller policy. What that means is our costs are going to be much smaller. So we end up seeing that here in our cash value. So out 10 years, our cash value in the old product grows to 553, the new product to 590. And you can see over 20 years and over 30 years. I'm a big believer in internal rate of return because that's how we know whether this is a good deal or not. And so the old product, it just so happened that when this changed, they also dropped their S&P cap from 9.5 to 9. So note that in the new product, 9 was the maximum, and we were illustrating a 5.7% return. We're illustrating 5.9 on the old product. So understand that these higher cash values are assuming actually a lower yield, right? And so look at this 20-year number, 4.45. So this would be the old number that says your client received 5.92% return on what I would call a gross return, but they had to pay for all of this insurance. And so when they got out 20 years, they really didn't get a 5.92% return. They got 4.45. So that means that the cost drag there was about 1.5% annually. And for that cost drag, this client got two things, right? They got the life insurance and they got the tax-free bucket. And I happen to think that that's a pretty reasonable deal, especially for someone in the top tax bracket. If you're in a 40% tax bracket, the taxable equivalent yield is closer to 7% that you need to get in order to yield 445. But here is what really blows my mind. In this product over 20 years, we had a 5.7% gross return. We ended up with 5.01 net. So what that means is the cost all in for this is 69 basis points. 69 basis points is crazy low to be able to provide death benefit and, more importantly, to grow a pile of cash. So in this case, she put $500,000 in, and over 20 years it grew to $1 million and did that all without taxation. Right? And by the way, there's a death benefit besides, right, to the extent that they die prematurely. And so what I really want you to know there is that those numbers are incredible. To be able to get something under 1%, it's the most exciting change that I've personally seen in the life insurance business since I've been in it. Did somebody have a comment or question? Andrew, did you have something?
Well, I think even Dave Ramsey couldn't argue with these kind of numbers. He's the one that's saying the life insurance is very expensive, shouldn't be used as an investment. But I think when you take a look at it, not all of it, but for a portion of clients' retirement assets to be used in a overfunded cash value life insurance, it makes a lot of sense, especially if that person is, young professional, 30s, 40s, can qualify for Roth IRA contributions because they're over phase-out income limits. This is the next best thing to Roth IRA, in my opinion. Yeah. And with a Christmas miracle, with that 7702 change, which again says that you need twice as little death benefit for the same amount of premium to have the tax advantages, that means that we've never had the contract that's this efficient to build cash value and tax-free income.
It's exactly right. And I think it's beautiful. And so where we see these cases coming from, as Andrew's alluding to, are those that have maxed out their qualified plans, aren't eligible for a Roth IRA. There's a lot of physicians, salespeople that end up doing these. And it's beautiful because you can ask them, if you could put more money in your qualified plan, would you? And most people that have maxed it out, if you ask that question, they would say yes. You ask them, well, how much more would you put in if you could? And they give you an answer. I would put $40,000 more away. That $40,000 is exactly appropriate for this kind of structure. You say, well, listen, it's nice. If you could put $40,000 more away, we'd have you do that. But where the qualified plan stops, the non-qualified plan starts. And so are you aware that the majority of Fortune 500 companies are utilizing non-qualified deferred compensation structures to fund their executives' retirement plans using specially designed insurance products? And that's how you can get into that conversation. And again, then reiterating to them that as beautiful as it is to be able to get $100,000 in a qualified plan, if I've got a cash balance plan, I might even be able to get a little bit more than that. As beautiful as that is today, how painful is that going to be in the future? Right? Because we're going to be paying fully ordinary income tax rates on the way out. And whether or not that client has an insurance bucket, they need to have a tax-free bucket, in my opinion, if they want to have a fighting shot at not getting crushed at taxes in the future, to be able to keep in lower tax brackets. And so this is a way for affluent individuals to get the feeling of a Roth IRA. Clearly, this is not a Roth IRA. You cannot say that it's a Roth IRA, but it sure has a lot of the same attributes that a Roth IRA has. So keep that in mind. Okay. All right, what next here? So we have a financial planning toolbox and an insurance advisor toolbox, and I'm not sure that you guys know about this. I want to make sure that you're aware of it, and I want to show you just a couple of things. So this is our receptacle that kind of keeps all of our marketing information and all of our fact finders and all of our scripts and everything else. And this is an insurance advisor toolbox designed to have everything you'll need to intentionally integrate insurance into your practice. And the way we have this thing laid out is we have it laid out by identification. Who do we need to talk to, right? We need to identify people to talk to. Then we have a positioning tab. How do we position? What language are we using, right? Then how do we implement? How do we introduce, right? Because we have people available for joint work, myself and others. It's going to be a very high level just to show you a couple of things. And by the way, if you want to look at this, definitely encourage you to do so. Please reach out to me or Andrew or George and we'll get that to you. So in this identification tab, there's this profiling tool. This profiling tool is very important because this is the who do you know, right? So this is about who do we talk to? Well, we need to talk to somebody about income protection. Right? So who do we talk to about income protection? People who got married or had kids, bought a home, changed a job. We call those qualifying events, right? Income protection from occupational disability, the same thing. So this is about protecting the money machine from a disability or a death. Life insurance and retirement planning, right? So who has maxed out their qualified plans? Who's unable to contribute to a Roth IRA? Who has 15 years? A lot of business owners. That's right. Right. So this is a 3-page form, and it goes into others, right? Retirement portfolio protection, which is long-term care, the single most important planning item that we deal with. Well, who should we talk to about that? Those that are generally 50 and older and are concerned about this. So again, this is a nice sheet for you to think about, who do we need to talk to? Because what we'd like to encourage you to do is find 2 or 3 people to talk to, reach out to one of us, and we'll help you talk to them, right? We'll help you bring the right kind of conversation to the right kind of person. So I'm back on this identification tab, and knowing that we've got a number of things, I want to show you this quick life insurance needs analysis. So this is a nice fillable form that we have that effectively you put you and your client, and then it talks about, again, our final expenses, mortgage balances, school loans, what income do we need for how long. So this is just another tool that you might be able to use. What I've found is that too many tools are bad, right? Because we get too busy. What you got to do is you got to find the 1 or 2 things that works for you. And so that's why I'm showing you multiple things, because I have a process and it works, but it's not the single best process that ever existed, and it's not the only process that works. And in fact, my process is just amended from a bunch of other people's processes. So I believe strongly in taking what you like and dropping what you don't, but you've got to have a plan for yourself so that you can intentionally do these types of things. So that was a little bit in the identification tab. I want you to know that our entire video library is here as well. So we've got Coaches Corners and other videos that we've put. So if you want to have additional training, you could come in here. Like when George was onboarded a couple of years ago, part of what we did is we had him systematically go through this material, right? So for an hour or 2 a week, he would come in and he would watch something and go through stuff and kind of systematically eat that elephant, if you will. Okay, so there's a lot of good stuff in here. Under the positioning tab, one of the things that I would like to show you here is, we do have review scripts and discovery meeting scripts, even maturing CD scripts, right? We have historical tax chart. That is a very powerful piece, right? Look at this, historical tax chart. Well, this is regular income and capital gains since 1916. This is the top rate on regular income. Well, take a look here after the war in 1944. We had a top marginal bracket of 94% in this country. Every dollar above 200,000, which I recognize was probably $1 million of income or more, was taxed at 94%. Do I think we could ever get there in this country again? I really don't. But we're at what, 37%, something like that at the top line. Look at the 70s. We had top marginal brackets, 70%, right? Above 215, which again was probably above $500,000. So you take a look where we are, and this sheet's a little bit old. I think we're at 37 right now, but look at these 30s, but we had 70s and 80s and 90s. And so this is very powerful to show to a client to say, what do you think is going to happen with taxes? And are you aware of what taxes were in the past? Right? Especially when you're utilizing that accumulation structure, because we're comparing the cost of insurance, that drag, to the cost of taxes in an alternative investment. So what you can see is that there's a lot of information in this toolbox, and it's continually breathing. So we're adding stuff to this all the time. So if you haven't seen this, please reach out to one of us and we will get it to you. Okay. So how do we apply this? What we really suggest that you do, and what we believe we sell, is the intentional integration of insurance. And in order to do that, you got to do something on purpose. And the something on purpose that we'd like to ask you to do is to shortlist 3 to 5 clients that need to have a conversation. Not that need to buy life insurance, but need to have a conversation. You can use that profiling tool, or hopefully you thought about some clients as we walked through this. Reach out to one of us and have a quick call. Have that quick call so that we can help you make sure that we're positioning, or that you're positioning that correctly, so that we can help you have a better conversation. When we do that, really everybody wins. And I think that that's really the key, because if we don't bring it to their attention, they're often not bringing it to our attention unless they might be sick, or maybe something bad happened to one of their family members, right? So that's really what we'd like to encourage you to do there. George, anything from your point of view? We've got about 5 more minutes here.
Oh, just the idea, as you pointed out, I started with the learning process and it's ongoing. And I really appreciate even today these Coaches Corners always adds a nugget for me, and I would look forward to connecting with anyone on the call who wants to expand their conversation.
Beautiful. How about you, Andrew? Last words from you?
Yeah, I think one of the easiest way to maybe identify who to talk to about is look at the upcoming client meetings, client annual reviews. And if there is a sort of a pre-meeting questionnaire that an advisor has already put together that they send out maybe 2 weeks in advance, if there isn't a conversation about life insurance or disability or long-term care, definitely put that in there, because if it's on the agenda, that means we need to talk about it. If it's not on the agenda, client assumes that we don't need to talk about it. And that could lead to problems. Obviously, now the fiduciary responsibility is heightened. So I would review the client pre-appointment worksheets and add those items if they're not already in there. And it's going to be much easier then to intentionally have those conversations.
That is a great tip. That's a wonderful tip. And that's an accountability piece too, putting it on that agenda. That's a really great tip. Thank you for bringing that forward. So you can see here's George's contact info here. And we've got Andrew's here. And then of course, I'm right here. We do record these. And so to the extent that you want a copy of the recording or you have a colleague that you think could benefit from this, please reach out to us. Our next Coach's Corner is going to be December 16th at 1 p.m. Central. So if you feel like blocking that time, you certainly can. You will get an invite from us similar to what you've seen for this one here. So with that, we are approaching the top of the hour. And again, I just want to thank you for taking the time here. And please reach out to me or George or Andrew, and we would love to help you help your client. The real benefit to doing this type of work is we do a better job for our clients. We drive additional revenue. We keep competition away. And we also protect our AUM, which ultimately increases the value of our practices as well. So with that, I appreciate you guys. Have a wonderful weekend, and have a wonderful Thanksgiving as well. Thank you very much. Take care.
Thank you.